Hey, John, very good to see you. Today, I want to talk about the recent market sell-off and just to walk through the pain points because they hurt. The S&P fell 8.8% for the month of April. The Dow declined nearly 5%. That was the worst monthly loss since March of 2020. The Nasdaq retreated more than 13%. That was the biggest decline since October of 2008. And if that isn't hard enough to stomach, let's take a look at this chart from FinViz, John. This is the S&P for the past month. When I see red like this, what am I supposed to think?
Well, I'm telling you what I'm thinking. That was the most depressing 20 seconds of video we've ever had.
Right?
But that's the reality. And to say this is a shock, it's not, right? Mark DiOrio, Brookstone said, listen, we can expect a 20% plus type of market, drop in the market this year. But even when we're being warned of it, when reality sets in, people don't like losing money, right? Fear and greed, that behavioral finance, the fear is always the most powerful feature. We're seeing that. So unfortunately, what a lot of people do when they see that chart, and I mean, you've got what, like Amazon is down 27% or whatnot, they panic, they start to get desperate, especially retirees who their livelihood depends on this money.
Right.
The desperation starts to set in, and they say, I can't lose any more money.
Right.
And they sell. And when they sell, they lock in their losses. And, this is what the markets do. We always talk about this with our clients and at our presentations, that the market will go up and down. But when push comes to shove, you have to understand your position in the down market and how much you're willing to lose. And you have to plan for that up front. Because if you panic and sell and you move to cash, well, you're going to be facing two issues. Number one, we're in almost a double-digit inflationary time period. So you're going to lose 7 to 10% of purchasing power. But also, it's a slide that Mark DiOrio has talked about time and time again in the past. Is something we've mentioned, that the best days of the market often follow the worst days. And as you can see in that slide, if you miss out on just about the best dozen days that the market has to offer because you're sitting in cash, your gains are significantly hampered. And a lot of those gains are recuperating your losses. So that is, and unfortunately, Dalbar has 30 years of data to back that up, that behavioral finance is one of the biggest risks right now.
Mm-hmm. And like Mark DiOrio also loves to say, and you say, those good days are smushed right up against those bad days, which is why it's important to stay disciplined with the approach, John, that I know you've thought through behind 30 years of studying all this data. So it's helpful to know that. I do want to ask, though, because there are a lot of experts who are advising investors to be defensive. So what does that mean to be defensive as an investor?
Well, I think to be defensive is to have investments that reduce your downside risk exposure. That's not going to cash, as we just mentioned. But, from our standpoint, from a retirement planning and our retirement designation and experience and knowledge behind retirement planning, you have to be defensive up front. You have to start your planning off with principal protection. How much money do I not want to go backwards? And then start to carve out your investments from there. So, it's not too late. You can start to look at investments like we did earlier this year when we started moving to more hedged equity and defined outcome investments with that downside risk. But the biggest thing you have to realize is that, in the good times, as we said, you have to plan for these bad times to avoid that panic mentality. Nobody likes losing money. I don't like losing my clients' money, but that's the reality of the market that we don't control. So, if you're going to be defensive, make sure you have investments that can still be defensive, but can be opportunistic when the market does rebound.
Mm-hmm. I feel better knowing that you have planned on this. Even though I was optimistic as a human being, hoping that we would just keep riding that high wave, at least I know that you're the realist for me, John.
Yeah, and you know what the good news is? We're no longer at the point of maximum financial risk.
Right?
We're at the point of people getting frustrated and maybe
Yeah.
disparity. But you know, that behavioral finance, the point of financial risk is behind us. So I guess that's the silver lining.
I like it. I like it, John. You've talked me off the ledge again. That was great. If somebody would like to talk through what's going on in the markets right now and how to make sure that they are hedged against this volatility, but also maybe even capitalizing on it, what's the best way to reach you?
Yeah, you can contact us two ways. You can give us a call at the office, 858-935-6210. Or you can visit our website, www.gosecurus.com. From either location, we'll set up either a 15-minute phone call to answer any questions you have or a 90-minute complimentary consultation.
Very easy. All right, John, thank you.
Thank you, Erin.